A number of events provided broader support to global equities over the month, chief among them on a corporate level, where we saw corporate buybacks from Apple be $110 billion, which is the largest in US corporate history. And we saw yet another explosive beat from NVIDIA in terms of their earnings update, where we continue to see operating metrics like profit outpace share price performance, which actually makes valuations metrics cheaper, as you can see on the slide, with the PE ratio coming down off its previous highs. Looking at the Bloomberg Economic Surprise Index in the United States, we're starting to see nascent evidence of data coming in weaker relative to expectations. So as you can see, any reading below zero here indicates a downside surprise relative to Bloomberg market expectations. Because of some of the downside surprise that we have seen to high-frequency economic data over the month, we see a downshift in the yield curve, as you can see from the end of April to what happened at the end of May, and more so on the long end to reflect a potential deeper cutting cycle relative to what was previously priced. So this indicates that markets have swiftly adjusted relative to expectations over the course of the month due to the slowdown. However, expectations did become quite V-shaped in terms of upside surprises to economic growth, so the overall data still remained robust. If we focus our attention on inflation dynamics, we saw that headline and core inflation over the month were dead in line with market expectations. And in the coming months, we see that owner's equivalent rent is expected to disinflate if the previous lead lag relationship with coincident housing price data is expected to follow. So owner's equivalent rent follows official housing price data with a bit of a lag, anywhere from 12 to 18 months. So this should help the inflation trajectory disinflate potentially in the coming months. So we still remain concerned over where the level of inflation is going to settle, and we believe that it could potentially settle at a level that is higher than the 2% target in terms of what the Fed is comfortable with, which may cause complications potentially from a policy reaction function. Asian markets over the month were particularly interesting. We saw a continued upturn in China over the month, largely led by high beta sectors amid several new policy initiatives being announced. So, for example, we saw $42 billion of funding being committed to buy excess inventory in the real estate developer market to help shore up liquidity dynamics in the debt-ridden sector over there. We also saw minimum down payment ratios going toward 15% from 20% for first-time home buyers, and toward 25% from 30% for second-time home buyers in order to support the broader property sector. The market was emboldened by these measures, as you can see in terms of the continued upturn in Chinese equities. Elsewhere in Asian markets, you can see that Japan 10-year yield moved above 1% for the first time since 2013. And that's amid the central bank committing to buy less corporate bonds in a future state. So they still remain concerned about the large wage increases that we've seen and the potential prospective impact that that will have on inflation going forward, as well as the fact that the yen depreciation may well filter through to levels of inflation that are incongruent with the 2% target. However, if we take a closer look at Japan, we see that inflation is not necessarily out of control, but these are more rather prospective measures that have been taken by the central bank to quell any potential re-inflationary impulse there.